What's up, traders? Anthony Crudele here, and welcome to the Futures Radio Show podcast. In today's episode, I'm joined by Craig Shapiro, 20-plus year macro trader and macro advisor at LaDuc Trading. We'll dive into Craig's background and get his take on how the macro side could help shape the markets. We'll discuss the highly anticipated Fed meeting this month, economic momentum as we head into November, and what it all means for key markets like the US dollar, bonds, and stocks. Craig will also share his thoughts on potential risks and earnings and why we could see more volatility heading into year end. Stick around for some great insights and strategies. Let's get started. Today's podcast is sponsored by FTSE Russell and TradeStation. FTSE Russell is the home of the Russell 2000 Index. Did you know that with an 81% share and $1.5 trillion in institutional assets benchmarked, the Russell 2000 is the top choice by far among institutional investors. Like all Russell US indexes, it's rules-based, transparent, and reliable, regularly updated with the latest IPOs and annually rebalanced. To learn more about FTSE Russell and their products, please go to FTSERussell.com. As a futures trader, you can leverage your portfolio even more thanks to TradeStation's reduced margin rates across popular futures products, including intraday rates as low as 10% on select U.S. index futures and low rates on popular energy futures products like heating oil and gas. Open an account today and access over 600 CME Group futures products and customize your trading strategies on a sophisticated platform built for advanced traders. Visit tradestation.com/Anthony to learn more. Craig, welcome to the show.
Thanks for having me. Really appreciate it.
We finally got this done. You and I have been talking on Twitter for a while. You've been blowing Twitter up lately too, man. I've been loving your tweets. And it really an interesting time in markets. I guess we could say that anytime, but right now, as we're recording here, first week of September, a lot to talk about.
Absolutely. It's back from summer, back to school, back to reality, I think. And, we are here on Thursday ahead of a critical non-farm payroll report tomorrow and a Fed meeting in a little less than 2 weeks. So a lot going on.
The most important unemployment number of our lives, Craig.
Right. Until the next one.
So because this is going to come out after unemployment, we know the markets are volatile leading up to it. And I think unemployment is going to set the stage for what I think is really obviously the most important thing coming up in September, at least we think it is what is the Fed going to do? Is it 25 or 50, or does 25 or 50 not even matter? What do you think?
Yeah, look, I mean, I think we've been in a situation where the market has front run the Fed several times over the course of the last several years. It winds up getting too aggressive. We got too aggressive on the hiking. The Fed had to slow that down. Then it's gotten too aggressive on the expectations for cutting. Earlier in the year, as we entered the year, the market was looking for 6 rate cuts to start the year, and then reduce those throughout the course of the year as the economy held up better than expected and inflation was stickier for longer. But, as we've pushed through into the third quarter, we're finally at a point where the economy is starting to show signs of strain and show signs of slowing, and inflation does seem to be moving more rapidly down to target. And so the question is, are we just going through, a mid-cycle correction in the economy, in which case the Fed can kind of pause easily and slowly and methodically and prevent us from cascading into something more sinister? Or is it already too late? Did they keep policy too tight for too long and that the economy is really rolling over and that they're going to have to, react aggressively over the course of the next few meetings? And so, look, I think at this point that the markets are expecting the Fed to react aggressively to an economy that hasn't yet proven or shown signs that it really needs that level of accommodation. And so right now, you have a market that is looking for 9 to 10 rate cuts over the course of the next 15 months through the end of next year. And as of the last Fed dot plot, the Fed was only looking for 5 or 6 cuts. So the market is way ahead of where the Fed said they were going to be as of 3 months ago. We obviously get another look at the Fed's dot plot at this meeting coming up in September. But the economy showing unemployment only at 4.2%, up from 3.5% or 3.4%. So that's a decent jump up. But if you look at 75 years of data, a sub 4.5% unemployment rate used to be considered maximum employment. So not clear that the labor market is yet aggressively slowing, and inflation is still running 2.5, 2.6, 2.7%. We're not back down to 2% yet. So with the S&P close to the highs, with credit spreads incredibly tight, we had an ISM services number this morning, which was the highest in nearly 2.5 years. To me, it doesn't seem like the economy needs the Fed to aggressively start cutting in September. So at this point, I think the Fed's going to be moving forward with a 25 basis point rate cut, but the market's going to be disappointed. And so we're in this kind of weird reality where the economy necessitates one thing, but the market wants more. And so it's a precarious setup, I think, for risk assets, right? When the market is going to be disappointed by the Fed and the Fed's reaction function, that's typically when we get bouts of more risk off. And so I think that's where we're headed here over the course of the next couple of weeks into the Fed meeting, and probably on the backside of the Fed meeting. Also have a pretty seasonally weak period historically. September, October, not been the greatest time for equities. We have some various liquidity squeezes coming with tax payments for September, tax payment in October, quarter end liquidity squeeze. So we also get the share buybacks stop towards the end of September. So the setup, the outlook doesn't look great. And if the Fed's not going to deliver what the market wants, there's scope for disappointment.
A lot to unpack there, and I'm going to go through this piece by piece with you. First off, I'm surprised that you think that the market is not going to be happy with just 25. And the reason I say that is because from where I sit and when I look at it, and I'm nowhere near where you are on a macro level, but I look at it just from a reactionary standpoint, I think the market would be like, whoa, the Fed's cutting 50 basis points here. Are things really that bad? I'm almost thinking that would be a more negative reaction than versus, okay, we're cutting 25 basis points. We're playing this smart. 50 basis points to me feels like we're behind. We're catching up. There's things out there that are worse. I mean, what are your thoughts on that argument saying that the market's thinking that 25 isn't enough?
Yeah, look, I mean, it's a little bit, they're damned if they do, damned if they don't, because they've kind of created this environment where risk asset and investors continuously front run them. And so it's almost, in this case, the market has front run the front run, right? I mean, I think what will wind up happening in the environment where, let's say this payroll number comes in okay, and we start to price out some of those rate cuts, you're going to have an environment where yields start to move higher. The dollar starts to move higher again, which is counter to how most folks are set up and currently positioned. And so you've had people plow into defensive sectors of the economy, of the market, staples, utilities, healthcare, real estate have all broken out to highs. And so if we have a situation where yields move higher again, all that recent outperformance is going to come unwound. And then the question becomes, okay, in a higher yielding environment where the Fed is doing less accommodating, where are you going to rotate into? What segments of the market do you really want to be part of? And I think that people will see this as perhaps the last good round of data here in August. Maybe it's the last good employment print. Maybe it's the last good services ISM. So yes, the Fed would only cut 25. There may be some relief that things aren't spiraling out of control. But I think that would rapidly transition to, oh crap, now we're losing money on some of this defensive posture we had. Where do we put our money? The economy still looks like it's slowing. And then the election uncertainty is still growing, right? We basically have, a 50-50 coin toss election here where folks are going to retrace in their outlays on goods and companies on hiring and on CapEx, because the winners and losers in the economy post-November are diametrically different depending on who wins and what the outlook looks like. If it's a Republican administration, a Republican sweep versus Democratic administration, right? Different sectors of the economy will do much better, and some will do incredibly, poorly, and vice versa, depending on the other side wins. So I think that pushes us into this uncertainty environment where, as the economy starts to slow further and grinds to a lower level, the market's then going to say, okay, the Fed's going to have to do 50 eventually. So it's a little bit of a weird setup in that regard, where when the market is so aggressively priced ahead of the Fed, there is scope for disappointment when we have to come back to the reality of what the Fed is actually going to deliver.
Yeah, that's a good point. When you look at it from the perspective of this recent bond move, because right now you've got bonds rallying, stocks are going down. They're not getting killed here, and we'll see what happens over the coming sessions, but, softening of stocks. But if all of a sudden that job number shifts and people think that the Fed is only going to be cutting, 25 versus 50, yeah, you could see a bond market that comes off hard. And I struggle to see a really big reason why that would rally equities, right? So they almost would see equities that are going down with the bond market going up. All of a sudden, am I right in what I'm thinking here? Maybe the bond
Yeah,
market comes down quickly and
right.
equities go down too.
I think so. I think we've been threading the needle here with equities for several months, where we've had rotations in the market, and the overall indices have largely remained fairly elevated. Even though tech is sold off, we've plowed into defensives, and even though small caps had underperformed and they've outperformed, and we've had this rolling market of where leadership shifts have not led to an overall decline. But I think we are getting closer to a point where we're starting to see earnings degradation, right? The expectation for earnings outlook for next year, low teens to mid-teens EPS growth just seems very difficult in an environment where nominal GDP is slowing and inflation is slowing, and the Fed's, call it 25 or 50 basis points or 75 basis points this year of cutting. It's just not really going to do much in order to improve the economy at the onset. So I think equities have disconnected from other asset classes. And so I think there's scope here for some cash out of equities as an asset class here in September and October, as buybacks start to move away, as the earnings outlooks start to deteriorate because of the election uncertainty. And so I think that's the setup that I'm concerned about broadly as an asset class. And so if you rotate out of defensives, where are you going to go? I don't think you're going to want to go into energy, industrials, and materials when we just had one of the worst global manufacturing PMIs that we've seen certainly this year, and if not for the last couple of years. Export orders slowing, confidence is weak in manufacturing. So China demand growth numbers have been pretty poor. So rotating into cyclicals doesn't seem like the right thing to do. And so if you rotate out of defensives and back into tech, and we've seen what semis have done lately, and Nvidia and big caps. So I don't know. It feels like we may be in one of those situations where this unwind and rotation finally leads to a larger beta down move, as people say, you know what, it's time for me to kind of take some gains, take some profits for the year. It's been a good year for equities, and the seasonality kind of wins over. And that's what I think we're headed into here the next 2 to 6 weeks before the election.
Yeah, you make great points, because it's not something I really thought about in terms of like the rotation. Because like we said, if all of a sudden it starts coming out of bonds, well, that trade's getting burned, where you're not going to run into crude oil. Crude oil's, you're not going to run into energy, right? I mean, because if we're slowing down, why would you go there? We're going to do step back into tech, and semis have been super sensitive to any bad news lately.
Yeah.
That trade just seems to be played out. Basically any rallies that are in semis, they're using that liquidity just to come in and just hit it. Nvidia, we heard that recent headline about the DOJ, and then, that really didn't, that wasn't the case. The stock didn't even bounce when that news came out.
Yep.
And so that tells you a lot, because like you said, where do they rotate next? And so I think, man, really got me thinking here, Craig, is if we do get a decent sell-off in bonds, if that were to happen, that does, I think, put some real pressure on equities.
No, I think so. And look, I think cash is still a pretty attractive place. It's hard to outperform cash at this point. And if you think that we're only going to get this 25 basis point rate cut, and even if we get 75 this year, cash and T-bills at 4.5 to 4.75, I mean, still pretty good, right? And if you think that the Fed is going to have a slow, methodical rate cutting cycle, then you're not really going to get burned by keeping money in cash, here in the next 10 weeks. And then if we get a situation where equities do sell off materially into the election, you'll be happier kind of then rotating that cash back into equities, for a year-end rally or a relief rally after the election is over. So I don't think the long end of the bond market provides a lot of value here. Buying 10-year bonds at 4%, I don't think you're, with term premiums that are basically negative. It's just you're not really getting compensated for that risk. And so I think that, folks will, if they start to sell out of equities, will rotate really into cash, or should rotate into cash, hold off, kind of wait this election cycle through, and then look for opportunities, in a sell-off to plow into, good stories for 2025. And, that'll be determined by whether or not we have a Republican administration or a Democratic administration. That may determine which sectors you go into and which ones will outperform. But I'd rather have dry powder in order to take advantage of that than, try to deal with some of the choppy to down moves that I expect over the next couple months.
You read my mind. I was going to say it doesn't hurt to keep the powder dry. It's a term we used to hear all the time on the trading floor. Just keep your powder dry.
Yeah.
And I guess the flip side of that is the Fed does cut 50 basis points. Does that, I guess, maybe reading the tea leaves that you're talking about, the market's kind of hoping that does happen. And maybe we just kind of stay where we are in this current cycle right now, where bonds are continuing to maybe grind higher. They expect the Fed to stay, continuing on this path of cutting more sooner than later, and equities maybe slow down to the downside and stabilize here and maybe just do nothing or grind back up. But I mean, is that what you're anticipating?
I think this idea that, well, if they cut 50, that's a scramble. And I think we already know that. I think we know that they're late by design. I mean, so I don't necessarily believe it's a scramble move if they were to cut 50. But yeah, I think what would wind up happening is the dollar would sell off and bonds would continue to rally. And you'd have that further rotation out of tech into defensives, into staples, into utilities, into gold. And you'd probably see, inflation expectations further out would start to move back higher again on the weak dollar. So I think that would be something that we could exist with, through the election, and then we'll see what happens. But yeah, I think people would say, all right, I could continue to sell semis. I'll keep buying Philip Morris, Costco, Walmart, utilities, healthcare, which have all been, up and to the right for a while, because I know the economy is slowing. The Fed said, is it confirming the economy is slowing? And so I want to buy yielding securities and defensives. But because the Fed is cutting 50, that means they're addressing it, right? That means that we're going to be quicker to the end point of a Fed cutting cycle than slower. And if the Fed, does 50, yeah, sure, I'm sure the market will say maybe they'll do 75 next time, right? So maybe we'll get into that dynamic. But I almost view that as a less bad outcome than if they say 25 and then the data really continues to roll over, because then they're even further behind the curve. So if they go 50, the dollar is going to weaken. And, that has some other implications, I think, for U.S. dollar denominated assets, right? We've been in a dollar outperformance, dollar U.S. asset exceptionalism trade for several years, which accelerated, when we started to hike rates and growth outperformed and big tech outperformed. So, if we get into a situation where the dollar starts to break down, I think there'll be some foreign selling of dollar denominated assets, particularly tech. So we could be in one of those situations that looks like the end of 2000, where the S&P kind of held on, utilities and staples, basically made new highs into the end of 2000, but big tech just kept selling off. And so the overall index, flattish, NASDAQ down, defensives up. I think that could be something that we would see if we got a more aggressive Fed easing sooner.
Yeah, I don't think many traders have seen a time like that. I have, and it's just it's that acceleration of that rotation. All of a sudden, it just, quick to exit, quick to enter the new one, and that could easily happen. And that usually is a very bumpy ride for S&P traders. That's primarily what I focus on, because we're seeing it right now. I mean, you look at the NASDAQ. The NASDAQ is the downside leader as of right now. At least when I look at my charts, it's what it's telling me. And the S&P is begrudgingly going lower, right? And then all of a sudden it just kind of gives up, right? And then you look around and you say, well, not a lot of these stocks are getting hit. And then all of a sudden it has a rally kind of out of nowhere. And so I agree with you. That could be a very interesting end of the year with that scenario. I want to move on, and I want to talk about seasonality, because I've heard August was the seasonality for weakness, and it's September and it's October. As a trader, as an investor, I always look at the macro. I read stuff that guys like you put out, your team and other people, and it's like, okay, if the macro is coinciding or not coinciding with the charts, that's where I make my decisions. If the chart's bullish and it's in a weak seasonality period, I'm not looking not to be long. I'm not really looking to be short because of seasonality either. So how much does it really matter? I mean, how much is it playing into your macro themes?
Look, I think there's different reasons why seasonality can matter in certain times of year and in certain years versus other years. I wouldn't say it's a driver per se of my process, but I think it's one of the tools or one of the legs of the stool that you have to consider amidst the macro framework, amidst the bottoms up earnings analysis. It's kind of time of year and even time of month. And from a time of month perspective, it's options expiry, right? I mean, we have such options have taken over as the dominant flow in any particular day, and certainly with 0 day to expiry options, makes it even more insane at times. But we have these quarterly expiries, and September is one of them, where folks have position square up type situation, and we may have a situation where the first couple of weeks of September kind of hang on, and then once hedges get reset after expiry, we have the markets trade truer again, because we don't have these Vana and charm flows, these buyback flows that dealers have to do as positions kind of get closer to expiry. So after expiry, markets can trade truer. And if the macro is bad, then we have adverse trading conditions. And I think the last 2 weeks of September historically have been, I think, the worst 2 trading weeks of the year. And a lot of that has to do with this kind of September expiry concept. But the other thing about September and October, and I mentioned earlier, was you have a big corporate tax payment that gets made in September 15th. And then you have the individual tax payment that gets made October 15th. And so both of those things remove liquidity from the banking system, right? You basically are taking money out of bank reserves and you're giving it over to the government, and it grows the government's Treasury General account goes up. And so that extracts liquidity from the market. At the same point in time, September quarter end also winds up becoming a fairly big window dressing, every quarter end really, a window dressing opportunity for banks. And so what banks wind up doing is they park more money at the reverse repo facility. That also, where yields are very high, that also extracts liquidity from the market. So if you look at the last week of any quarter end, we have these liquidity drains. And it looks as though, for the last several years, the worst sell-offs that we've seen in markets have come the last week of the quarter because, commensurate with this liquidity drain. So, all those reasons are why that September, October period historically has been dicey. I would add also this share buyback concept, right? September 13th is the peak day for share buybacks. Every day beyond that, we start to lose share buyback support because companies go into blackout period as they approach their earnings date. And so the combination of all those things extracts liquidity from markets and sets up an environment where macro can overwhelm the flows. And if the macro is in a poor place, which I think it is right now, as growth is slowing and the global momentum is deteriorating, the bar is lower, right? We can trip up a lot more easily in these environments.
Honestly, one of the best explanations of how seasonality plays a role, talking specifically about options expirations, end of the quarter, that stuff is of great importance to all traders and investors. And I appreciate you sharing that, Craig, because I think that is what gives people an understanding of how seasonality actually plays a role during this time. I want to talk about the risk of negative earnings or earnings not meeting expectations, when we get towards the end of the year. Bob Elliott was on the podcast earlier this year, and I think he's really been pounding the pavement on that, at least from the people that I follow early on and have been on the show talking about, Anthony, things are running higher because people are catching up to earnings expectations. They keep getting, higher and higher in the markets going and they're beating them in a lot of cases. I mean, look at what NVIDIA did. I know things might be shifting a little now, but nonetheless, that's where we were, right? And that was one of the biggest drivers, God forbid, right, Craig? Earnings were driving price action higher versus what the Fed was going to do. So now we're in a situation where you said things are slowing. You're seeing some cracks. How big of a risk right now do you see that earnings don't hold up year end?
Yeah, I think Bob has done great work on this, and I think what he has referred to this is an earnings expectation problem. If you look back at the actual earnings momentum that we've had over the course of the last 4 to 6 quarters, we really haven't seen the level of double-digit earnings growth. We've seen more in the flattish to mid-single-digit earnings growth for the S&P over the course of the last several quarters. And what winds up happening is earnings expectations get way too high, and then we have a little correction. Then they come in as we approach the quarter, and then the companies come in and they beat these revised lower expectations, and then the market kind of keeps moving higher again. But I mean, I think we are finally starting to see some larger cracks. I mean, even just the last couple of days or weeks, we've seen these dollar stores, right? Dollar General, Dollar Tree, kind of low-end consumer facing, putting up, suspect and sanguine outlooks and stocks getting destroyed, right? And so I think some of the consumer facing parts of the economy are seeing that earnings growth deceleration. And then for something like NVIDIA, right? I mean, we've already seen peak sales growth momentum on a year-over-year basis. And now we've seen peak earnings growth momentum on an annual basis. And so we have decelerating rates of earnings growth. And so that's new for the AI theme as of the last quarter or so. Look, I think as we head into 2025, the market's looking for 12, 13, 14% earnings growth in 25 versus 24. If we're moving from a 3% real GDP world to a 1 to 2%, maybe lower real GDP world where inflation is moving from 3 to 4% down to 2%, right? You're chopping off a good part of the nominal GDP momentum. And then, do companies really have pricing power? Do they have the ability to pass, higher costs onto the consumer? Not really. And so I think margins are where we're going to see a lot of the headwind and a lot of the squeeze. And look, companies have been over earning for years, certainly since COVID. Margins, broadly speaking, are way higher than they have been historically. So I think there is room for margins to get hit, for earnings growth to get hit, while the overall economy maybe doesn't cascade into, a massive contraction. And I think that's a dicey setup, broadly speaking, for earnings and for equities as an asset class as we head into 2025. Now, the election will matter, right? The tax regime will matter for companies, for next year and for 2026. Do we have a return to a higher corporate tax environment under a Democratic administration, or do we remain at a low tax rate under Trump? I mean, TBD, but that would be another potential headwind if Harris wins, is that corporate taxes will be going up next year. And that would be another headwind for S&P earnings. So that's what I'm worried about as we head to next year. And it's not like the market is particularly cheap at this valuation. If instead of doing 240, 250 of earnings next year, we have, we're in the 220, 230 camp, which would be, kind of a standard garden variety slowdown. What did we pay on 20 times 220 is like 4,400, right? It's not 5,700. So I think we're at risk seeing some earnings degradation and a multiple contraction amidst that slowing growth. And so, my outlook for equities is not particularly bullish at this point.
You've been writing a little bit about October volatility hedges. Now's the time to start looking at those early in September. Talk about that a little bit.
Yeah, I mean, we obviously had this incredible move in equity volatility towards the end of July and through the first week of August as, after the Fed meeting, when they came out, they didn't cut rates. And then we had the dollar yen move and the yen carry trade unwind. We had that weak payrolls print and the markets kind of freaked out and cross asset markets were unwinding. The VIX went to 60 plus and kind of felt like, okay, people have figured out, it's going to be a volatile, choppy situation between now and the election, let's say. What wound up happening is that the equity vol crashed, right? We basically had the largest and quickest decline of a VIX spike that really I think we've ever seen. And so we kind of got into a situation as of last Friday, the end of August, where vol for October was back to the low price of the year. After everything we know about the economy slowing, with all the election uncertainty, with dollar yen carry trade unwinds, I mean, equity vol got, imploded again. And so if I look at cross asset vol, dollar yen vol has started to move back higher again. Fixed income vol, as measured by the MOVE index, is moving back higher again. And equity vol has not kept pace. And so I felt like there was an opportunity there to start buying hedges again for October. To kind of capture this next Fed meeting, to capture some of these liquidity concerns that I've been talking about. And so, as of last Friday, I mean, October VIX was at the lows of the year. And so, it started to move again already this week. I think there's still opportunities here for, to deploy some hedges. And if we have a little bit of a relief rally into the Fed, again, I think I would still advocate, being hedged up for October and maybe even, really through the election period.
I mean, it just makes sense. I mean, the market is really set up for a volatile end of the year. And we had that, we'll call it the V top in the VIX. When volatility starts to come back down like this, I mean, if you have a big portfolio, I mean, I think you got to be kind of crazy not to look at volatility hedges going into the end of the year.
I think if we had that VIX spike like in October, it'd be more likely that was the true top. But to have that early in August, it just felt like it came too soon, too quickly, and that we can have another bout of, a VIX move and an equity vol move, one more time before the all clear bell is rung.
I would agree with that. Anytime something happens in August, I always hold it with a grain of salt because no one's even there. I wasn't there. I mean, I'm not saying that matter, but so many people are taking time off in August. And I've learned over the years that, August is always a great time because even if something big does happen in August, it always seems to end up being kind of where it was when I left. And that happened again this year. So who knows? But yeah, I think that looking at the end of this year, when volatility comes down, to have some hedges on, I think it just makes sense. I think it's going to be busy no matter what. Let's talk about year end. We know there's a lot that could change, but from your standpoint, what do you see setting up for the end of the year? How do you see this year going out?
I know this is a little bit of a cop-out, but the election result really will help dictate what the next iteration of the trade and the economy and markets look like. And I think that's rare to say, but the disparity between the candidates and the plans that they're looking to kind of build in are so different that it really matters. But I think between now and the election, as I've stated, I'm expecting down markets, risk-off environment, concerns about over-earning in equities, and an uncertainty-driven slowdown here for the consumer and for companies. And so I would expect, asset prices to fall between now and the election. And it'll probably create an environment where volatility is extremely elevated for the election, kind of similar to what happened in 2016, where vol was extremely bid for that day and night. And people thought, well, if Trump wins, it's going to be market disaster. And really what wound up happening was he won and vol got sold aggressively. And so markets were able to levitate and kind of we were off and running. We could be in a very similar environment again, where volatility is elevated into the election and Trump wins, and we have a sizable relief rally based on a view of a more of a pro-business, lower tax regime. But he's also the deficits are going to grow under either one of these candidates, and the dollar is likely to weaken under both. And so I think we could be in a situation where bonds really start to weaken to the end of the year, and we can have materially higher long end yields for 2025, right? I mean, basically been running kind of 6 and 7% of deficits, GDP of deficits for the US. Those numbers are going to grow if we have a slowdown. And so the long end of the bond market to me is of great concern. I think down here at the 10-year at 4% or so is way overvalued. I see a much higher yield environment for the long end in 2025. I think we'll have a decent curve steepener, but that relief rally that comes in November or into the end of the year might get returned back down as we head into 2025 if we're faced with a higher interest rate environment, a still slowing economy, a Fed that's cutting, but it's not really doing much to stimulate demand. And look, if Trump comes in and we have tariffs on China and retaliatory action by China on the US, I mean, that could be a dicey setup. So I don't know. It just seems like we have a situation where it's kind of down now, maybe a relief rally into year end, and then walk in 2025 and things don't look as great anymore. And then the other thing that could happen is if the dollar really starts to weaken and commodities find a floor and start to move higher again, then we have a situation where we're looking at a reacceleration potentially of inflation, call it, second quarter or third quarter of next year. And then what happens? And then how much more cutting can the Fed do? And if we really start to lose the dollar and lose the bond market and commodities start to move up again, then we're in a really tricky spot. So I'd say, again, bearish, then a relief rally, and then probably more concerns in the first quarter of 2025 as we have to really digest whatever the new administration looks like. How much of a slowdown did we have? How aggressive was the Fed in cutting? And whether or not inflation starts to come back again next year.
Man, bond market's so important right now. I mean, it's always important, but it goes through periods where traders out there are looking at it and it's just not doing much. But right now, man, got to keep an eye on what's happening in bonds. I mean, it makes me also want to add more gold in my portfolio. I bought some gold last week.
Yeah.
I might be hanging up with you and buying some more gold again. I don't know, but it feels like, being long gold is probably not a bad idea.
Yeah, I've been pretty bullish on gold, for a while now and remain so. I mean, gold continues to find an increased role as a global neutral reserve asset as more trade is being done away from U.S. dollars, right? I mean, BRICS trade is getting done away from dollars. The U.S. has, sanctioned Russia, expropriated reserves, has made it more difficult for enemy states to desire to keep their capital in the U.S., and that has an adverse impact on treasuries. But you have to find, if you're a country, you have to find a place to store excess reserves. And gold is increasingly, once again, becoming part of that solution. There was an announcement today that Russia is again in the market buying gold for the month of, coming up for the month of September and October, literally just selling oil, for gold. China continues to buy gold. It's becoming a bigger deal. And so I think that's the structural story there. And if we have an environment where the Fed is aggressively cutting and real rates start to move lower again, that historical relationship of real rates and gold will reconnect. And that's been something that's been missing this cycle. As gold has really outperformed despite the rise in real rates. If real rates were to fall, I think that's could be a next explosive leg for gold higher.
Right now, gold has got a big macro backdrop and the technical to support it, which is, a market you want to always keep an eye on as a trader or an investor. Craig, this was great, man. I got to tell you, it's been a while since we first started chatting on X. Love that you're tweeting so much more. I mean, it's been great. I mean, your posts have been fantastic. Definitely one of my favorite follows out there. And I just appreciate you taking the time, chatting with me. Let everybody know where can they follow you on X. You definitely got to go and follow Craig. He's great. And then also the website.
Yeah, it's great. You can follow me. My initials are CES and then my 921. So my Twitter handle is CES921. I also provide strategic and macro counseling to clients of LaDuc Trading as an advisor for them. And so, but yeah, you can find me either one of those places.
Go follow Craig. Go check out what he's doing at LaDuc Trading. Craig, this was great. I look forward to chatting with you more on X throughout the end of the year. Looking forward to seeing your posts and can't wait to have you back on the show, man. Thank you so much.
Thank you. Appreciate it.